Hello, Kiola. Lucia here, property investment mentor and founder of the Finax Mortgages and Insurance. This is the recording of 1 hour live webinars. If you would like to join us in our next webinars and be part of the Q&A, please head to our website, luciaxiao.co.nz. I trust you will definitely learn a lot from this video. Thank you. Awesome. Yeah, okay, wonderful. Cool, yeah. So, it might be because we actually have probably some like a customer, they are kind of like just coming from our Facebook ad. So just in case like if you had not met me before, you don't know who I am. My name is Lucia Xiao, and I'm the property investment mentor, financial advisor, and also founder of the Finax Mortgages and Insurance. Yeah. And also, I'm the author of the book Financial Freedom 5 Steps 5 Years. Yeah, so basically just a personal story of myself from living in a stay house, then later on build a $17 million property portfolio in just 5 years. Yeah, I mean, like obviously, I'm not here just to show off something. I just want to prove to people that everything can be done. So if you have a dream, don't limit yourself, and dreams do come true. And of course, it does require a bit of your determination and also the support from other people. So joining us tonight, of course, is one of the great chartered accountant, Allbright, and herself is also a business coach as well. And I think she used to be a property coach as well. For some of you, maybe you actually know about her. Yeah. So Allbright actually have a wealthy knowledge in the accounting and also in property investment. Herself is a very successful property investor as well. Yeah. So obviously, I think tonight's webinar is going to helping you, especially like if you are running your own business. It's so important. You do need to understand your numbers. Yeah. Because very often I come across people, it's like, they don't know their numbers. Yeah. So if you don't know your numbers, of course, the money is not going to work for you. Yeah. So just tonight we're going to have Allbright to join us, and she's going to share with you, her knowledge with you. Yeah. Okay. But you can take over now, Allbright. Yeah.
Excellent. Okay, just thank you for Lucia to invite me here. We have been knowing each other, and everybody knows great. Lucia is such a successful property investor, and I learn a lot from her, to be honest. And just as our discussion there, we noticed a lot of business owners actually do not really understand their finance. I'm just gonna share the slides and to help you understand. And I'm gonna tonight. There was no slides here again. Yeah, and
yeah.
Okay, excellent. I just go for the first page. Okay. So today, as what Lucia said, we are going to talk about the financial literacy and the cash flow management. And I believe that's very important for all the business owners to understand your financial. Just a disclaimer that the information I'm going to talk about tonight is purely for the general information. If you want to seek specific information towards your personal situation, please discuss with your accountant or get the specific professional advice from your lawyer accountant. Okay, so yeah, as what we discussed, 2 topics today: financial literacy and cash flow management. And we all know accountancy, but we always think accounting, a lot of people just think accounting is just purely to tell me how much tax to pay. Just say yes if you believe that's what you think. Just in the chat, just type yes. If you think, oh, what accounting does is just to say, I just need to get my accountant to tell me how much tax to pay. But not many people understand accounting is actually language for the business. You need to understand and read the financial statement to understand how the business performance goes. And a lot of people think accounting is a foreign language. And a lot of people, when they read the numbers, is a big headache for them. And we are here just to telling you guys today, talking about 3 very important statements you will see every year if you are in the business or in investment. There was 3 very important documents profit and loss statements, balance sheets, and the cash flow statements. Okay. And I believe accountancy, when you read the numbers, it's like your dashboard. Just imagine a person who jump in the car and they cannot read, they do not know what's the speed limit, and they do not know, they can't read and understand if there was still enough petrol in the car. If there was any emergency, they do not know how to turn on the indicators and the lights to turn left and right. It's going to be very, very dangerous and scary. So we do not want put ourselves into the situation. This is like we are running the business, and if we do not read the numbers, and if we do not understand how to drive our business further, that's going to be very dangerous. So let's start by looking at the profit and the loss statement. And as we all know, the profit and loss is the statement is shows the sales, the total sales. That could be, depends on the industry you are in. That could be, let's say, could be your sales for the products, your professional services if you are in the service industry, and it could also be your the revenues from the hours if you are a contractors, the hours you've been putting for contracting for another business, and that related with different type of expenses for the business. But anyway, I just want to know how many of you believe when you receive a profit and loss statement by the end of the year, this is the only location, that's where I circled red, this is the only location you look for. I just ask, how many of you, when you receive a set of financial statement, the first thing you look at is where I circled red, and you don't really look at the top hats? All you want to know is, is my business making profit, and how much tax do I pay? Okay, Sally says yes, understand, and yes, yeah. Okay, so yeah, I believe a lot of business owners, this is the only place they look at when they receive the financial statement, and they only look at this once a year when they actually receive the financial statement. During the whole year, a lot of a business owner, when you go to an accountant, when you go to a mortgage broker, and they ask you, how much do you earn? And they said, I'm not quite sure, I don't know, I need to ask my accountant. And a lot of businesses owners are actually in this situation. It is very dangerous. And it's even more dangerous if you don't even look at here. You only look at your tax return, and look at tax return, how much tax you pay. You are not really driving your business forward. In that case, you don't really understand your business, I have to say. And that's really, really dangerous. Okay, then we need to have a look at the balance sheets. So the balance sheets is combination of the things and stuff you have in the business, and what you own and what you own. So the things and stuff you have in your business could be cash. That could be your whatever the cash left in hand, and what the balance left in your bank accounts, and it could be your accounts receivables, and which means by end of the year, 31st of March, if you completed the job and send the invoice, however the client has not paid until April. Inventories, if you are in the industry of manufacturing or some other business which will give you the end of the year stocks, so that could be your inventories. And property and plants and equipment, that's your fixed asset. For a running trading business, that could be your car, your machineries, your office furnitures, and for investors, that could be typical your residential rental properties. That's going to be the things and stuff you have, and that's formulated to be your assets. And by holding on, by having this all of those things and stuff, you may not pay the full amount. Hence, you own the money to somebody else. That could be your accounts payable. And together with that, you need to pay tax, and it could be your tax. And you could have business loan, or if you are in the the investment industry, in property investment, that could be your mortgage and the loan to the bank. So this is the money you own somebody. And when you minus by the things and stuff you own and take off the obligation you own to somebody else, and this is your equity, which means you own this property. You own this the equities here. So in your balance sheets, that will be shown as your current earnings, which is the earnings for the current year, or your return earnings, which would be the accumulated earnings since the business started until now. So basically, it's that's simplified. For the balance sheets, it's purely showing the things and stuff you have, which equals to what you own and what you earn. And that's assets equals to the things and stuff. And the liabilities is the money or the debts you own to somebody else. And the equities is what you own. That's balance sheets. Okay. So we have to say the balance sheets is actually screenshots. It's just to tell you. We just talk about what is balance sheets. It's at the end of the year, shows at 31st of March how your business look like. And this is to show you the whole year's performance from 1st April to 31st of March. Okay. The profit does not equal to the money you can spend. Because let's say if you go to purchase something. Okay, Kelly, and it says, yeah, that's correct. Eldon says, I wish. Okay, so if you go and buy a car, you can't say, okay, I will give you my profit. Can you give me the car? They will say, no, I'm not going to. How can I spend your profit? I need your cash. So there was another very important statement called cash flow statement. So this is where the real money goes. This is the money you can spend. And there's lots of business owner confused. They always say, oh, I think my accountant told me I have solid profits. How come I don't see any cash? And why do I have to pay so much tax? And a lot of people, they don't really understand cash flow. So cash flow statements shows you the operating cash. That is basically the nearly equal to the profit you have here. That's operating cash. On top of that, you have to take minus or plus the investment cash. Investment cash could be the money, the loan you borrowed, or the loan you paid. And the finance cash, and it could be how much finance you need to pay for the, the invest could be the shares and all of that you purchased. That does not calculate it into your profit. And the finance cash could be the interest payments and the loan payments. If you are lending from a second-tier lenders, you might need to pay some application fees and all of the things that's called finance cash. After operating cash, which is the cash by running the business, minus investment cash and minus finance cash, then whatever left in your pocket is the ending cash you can spend. Now let's have a quick look the relationship between those three statements: balance sheets, profit and loss, and the cash flow. Oh, there was a typo here, sorry. And just when you reading your profit and loss, and when you see your end of the year figure, the profit, it's going to shine in your balance sheets as the current year earnings. Current year earnings is here. And when you finish the cash flow, that's going to be showing how much cash you have in your bank or how much cash actual notes you have in your hand. I hope you do not have too much notes in hand. Okay. just like some other people would have a safe at home to store all the cash. Hope that does not happen to you. And anyway, that balance sheets just shows you in the things and stuff shows you the cash which you can spend, and in the current earnings shows you the profit and loss profits. Okay, so that's a relationship between this statement. And by reading this, you need to understand how healthy your business is. So if you have a huge profit here in the profit and loss statements, it doesn't mean you have a huge cash flow here, which is in the cash. So which means if you have a huge earnings for the year, it doesn't mean you will have a huge cash in the things and stuff you earn. That may be because you have huge receivables, the money you have not received, right? Or you take too much inventories, which means you have bought too many things by the end of the year, and those stuff stock in your storage and have not been sold. And maybe you purchased, by whatever the reason, you bought a huge plant and equipment and spend a lot of money, and that could end up you have very poor cash flow. And we have to always see, let's look at this quote. The fact is that one of the earliest lessons I learned in the business was the balance sheets and the income statements are fiction. Cash flow is reality. So we come back to here. The balance sheets only shows you on 31st of March how healthy your business is. Profit and loss only shows a movie what had happened for the year, but the reality, how much you can spend, you have to read the cash flow statements. Okay, so let's have a look about the cash flow management. So we all know the profit does not equal to cash. And let's have a look at the main difference between the profit and the cash. So basically, the sales value minus the cost of the stock and other expenses equals to the profit, as we all know, which shows on the profit and loss statement. And all the cash inflows less all the cash outflows, including GST, equals cash. So we have a look at the table here that basically shows us some ideas what is be recorded in the profit and loss statement as profit, and what will be recognized as cash into the cash flow statements. Okay, GST. GST goes to the cash flow statements. So a lot of people, when you say, oh, the accountant told me I have a huge profit, however, I don't have enough cash, that maybe you have a huge GST to pay, which go out of cash flow. However, it does not record it or recognized into your profit and loss statement. The loan repayment, as we all know, the principal statement, the principal you paid for the loan is not deductible for tax purpose. Hence, this does not include it in the profit and loss statement, and this will reduce your cash in the bank. Interest on the loan. Yes, interest on the loan is recognized as a deductible business expenditure. Hence, it's recorded into the profit and loss statement, and it's also recorded in the cash flow statement, and this money will go out of your bank account. Cash spent on assets. So a lot of people like to buy luxuries and buy big cars and huge nice machineries and all of that. So when you spend the money on the assets, if the asset is helping you to accumulating income, which is okay, that will bump up your cash. However, if you are only buying luxuries, let's say if you bought a Lamborghini in your car, in your company, that's going to be hugely reduce your cash, and that is not recorded into your profit and loss. in that case, you may say you have a very healthy profit and loss, but you have no cash left in the bank account. Yeah, cash received from sales of assets. If you sold, well, that's only apply. Let's say if you are in the residential rental property market, the business, and if you sold your property, you may not need to pay cash for the property you sold. However, you will have money in. In that case, your cash will be increased. Also, it doesn't show in the profit and loss statement. Depreciation does not, because you bought the money already. Depreciation is recognized the wear and tear for the goods, for the assets and the fixed asset you already have in your business. Hence, it's reduced your profit by the year, but it does not reduce your cash flow in the bank, which means you do not have to continuously pay the money off your bank account for depreciation purpose. Okay, so that basically gives you a quick idea what is a profit and what is cash. So we can clearly see profit does not equal to cash. And we and all of us know, okay, a very successful business which makes huge profit can, by whatever the reason, they could die because of very low cash. But if a business always running losses, may still survive for many years, however, because they have really good cash flow. So, and for us as a business owner, running business, we need to clearly understand how we're gonna read the financial and to increase our profit, at the same time keep the cash flow positive. And by doing that, we need to have a look at the 7 causes of poor cash flow. When we understand that, we will be able to manage that very well. And as we noticed, a lot of people saying, where does my money go? Because my accountant shows me a lot of very profitable financial statement, and I don't really understand why I need to pay so much tax. I don't really earn money. And lots of business owners have these questions. Okay, as we mentioned before, one of the criteria, one of the items shows on the balance sheets is accounts receivable. And if you have huge accounts receivables in your account, and if your accounts receivable process is very slow, that's going to be largely affect your business. And if you, let's say, if you have a business which you have the turnover of the accounts receivable every week, that's going to be much healthier cash flow compared with a business you can only receive the money for once every 2 or 3 months, regardless, even though you receive huge income. If you do not manage well, that's going to be largely affect your business. Accounts payable. Accounts payable, if we can, a good accountant or internal accountant bookkeeper, always trying to pay the money by the due date. Because the longer you can drag the money, the better cash flow you will have. Okay, that's the accounts payable process. Or maybe you can negotiate with the provider to give you a longer payable period, and at the same time you can encourage your customer to give you, maybe you can offer slightly discount to encourage them to pay earlier. That could help you to encourage the cash flow. Inventory process. Okay. Try to review your inventory. Do not keep too much inventory. One, that's the goods stocking your storage, and it is not gonna give you a good return. Secondly, you have to spend extra money to pay for the storage, and if the goods has been stocked in the storage for longer than necessary period, that may becomes the losses or the wastage. So to keep a good healthy inventory level is very important. And here, inappropriate debts and the capital structure. So a lot of people don't really have a good capital structure or loan structure, or they borrowed a lot of unnecessary debts. Could be the personal debts, could be they have cash but they borrow the money. I mean, when they purchase the luxury goods, that could be they bought a luxury car by borrowing the huge expensive lending or the loans from the second tier financial companies, which is unnecessary. And that could be overhead is too high. Say if you have a business, very small business, so you have 1 or 2 people, and it's very, if you do not have the certainty how to grow the business, it's maybe unnecessary for the stage for you to hire a huge office, or maybe it's unnecessary if you do not have enough cash flow or revenue. Maybe it's not unnecessary for you to hire too many staff members if you cannot pay them. And maybe your profit margin is too low. You maybe need to review the market and have a look if there was any way you can increase the profit margin, or the sales level is too low, and this is going to be the typical question. Maybe you need the good marketing. But anyway, these 7 points gives you an idea how you can review your business and rate your financial, and how by understanding the financial statement, and that will assist you to grow your business by having healthy cash flow. Okay, now we have a look. This is more related to the actual trading business for whoever in the in the manufacturing industry, service industry, or physical trading industry. And now we have a look what is going to impact the cash flow for a lot of property investors, also for the business owners. A very typical increased, very typical changes for the tax rate to 39% start from 1st April 2021. So this says for the personal tax rate, for whoever earns more than $180,000 from 1st April 2020, the tax rate increased to 39%. This will, for somebody who's in the good income and good profits, this will add extra burden into your bank account. You need to pay extra tax, okay, 6% more. The company and trust rates doesn't change. And as property investors, this is the property changes along the years. I mean, the legislation changes for the property investors. But it's the most shocking news happened on 27th of March 2021. Government announced a introduction of the new rules they're gonna put into the property market. And the most shocking news, and what will largely impact our cashes, is going to be the interest deductibility phased out rule. And this is very likely start from 1st April 2021. And for those of you who do not familiar with this rule, this basically says if you purchase a property and the property is go unconditional after 27th of March 2021, then after 1st October 2021, the interest paid on mortgage are not considered as business expenditures anymore. In that case, a property investors for buying whole purpose could be facing a big cash flow out by paying extra tax. And for the properties which is go unconditional before 27th of March 2021, including the properties you already settled on a hold for many years, it's going to be phased out within the next 4 years. And it will reduce 25% of the ability to claim tax until 2025. The interest will not able to be deducted as your business expenditures. And this rule will largely affect small investors. Especially you have only 1 or 2 properties, and in PAYE industry, that's going to be a huge impact. And especially, Lucia maybe cover a little bit later, about the government is considering about the OCR changes. Luckily, it hasn't changed yet, but it's proposed to have an increase in next year, because the OCR change may happen next June. And if the OCR increases, the interest rate also is going to be increased. That will also impact your cash flow. So for the property investors, need to really review your ability for the payment, and especially when you go for further investment, it will be a good idea by not purely looking at how much salary you have. And for business owners, it's not a good idea only look at your tax return and your profit and loss account to see how much profit you have. Instead, look at your cash, which is the money in the bank, and do a really good budgeting and planning according to all those changes, which is going to happen shortly. And by reviewing your business, try your best to increase the cash flow and bring the healthy business. Okay, so this is my talk. I think it's coming to the question time.
But I think I'm just going to add a bit more there about the borrowing ability, because I think people in business, they also want to know, hey, how is it going to affecting my borrowing ability? So luckily, from the bank point of view, they don't really look at your cash flow statement. I think a lot of bankers probably not really coming from the accounting, so they don't really care about how healthy your business. I think all they look at it was just your profit and loss. So a lot of them, some of them, they don't even look at your balance sheet. Only the more experienced when they kind of look at your balance sheet, understand like where you at, sort of things like that. So in that case, obviously, if it's only profit and loss, I think it's quite possibility. I think Allbright was talking about it. Yeah, you can make a good profit, but not necessarily you have a cash flow. So that's kind of like most of the bankers, because a lot of them, they are just not quite understand how business runs, and they don't really actually looking this cash flow statement. But in terms of the cash flow, of course, it's actually decide whether or not your business can survive. A lot of you, if it's you running the business, you will know that although your company might be making a profit, but it doesn't mean that you are having a healthy cash flow coming into your company. And if it's without a cash flow, the business can be starving. Yeah, so it can be very dangerous. Yeah, so that's something that you have to be very careful. But from the bank point of view, basically all they look at it was just your profit. Some bankers, they probably look at a balance sheet as well. And also another thing is like not many accountants, they are also probably investors there. And I think a lot of accountants, they are really only focused on like how just pay less tax. Yeah. So I had heard my customer came to me and said, my accountant suggesting me to go and buy a brand new car. It was just awful. Okay. So just be very careful with the accountant that don't actually have the property investment background, because if it's you are making a good profit, you're making a good income, you should really investing in a good asset, not just buying a new car. So you can actually reducing your tax bill, which is just don't do that. Yeah, okay. And also when we're doing the mortgages, there are lenders. There are a couple of lenders actually like they do allow us to actually add back your depreciation. I think Allbright explained that, depreciation doesn't really affecting your cash flow, because it's just on the paper, you're making a loss there. Yeah. And also it does allows you to actually add back the home office, so there are lenders actually allows us to actually add back those ones. So although it looks like your your profit is low, but however, their lender allow us to add back. But their lenders say, well, sorry, if that's your expense, we just not going to consider adding those back. But obviously it depends on your scenario. We will know which lender we can actually submit your application to. Yeah, okay. And also the okay, I think Allbright kind of touch base about the OCR increasing. I think this at the moment, on the market keep talking about it. Next year, OCR is going to go back to 1.25%, which is just because
next year June.
Next year, yeah, I think they talk about it. Yeah, okay.
Yeah.
And being honest, those are just the prediction, yeah. And myself, it's always been like no one's able to predict anything, yeah, because you never know what else will happen, yeah. It just no one is thinking that COVID-19 is coming, you know, because otherwise more people will be more prepared, yeah. But no one really knows, yeah. And also, I think ultimately, you know, ultimately you have to understand the bank or the main bank, they will prefer customer to lock into a longer term fixed rate, yeah, because they got much better profit, much better, you know, margin there. So that will be their purpose, you know, trying to pushing people to, you know, by saying, hey, interest is going up, lock into a 3 years term, 4 years term, lock into a longer term, yeah, okay. So my suggestion is always just like, you know, there's no need to be panicking or something doing so, you know, like, and I always suggesting, you know, just always looking for 12 months, 18 months, you know, like a fixed rate, which is the lower and adjusted. And I think even like with the interest rate, you know, like, because people worry about, oh, what happened, the interest rate goes up, how I'm going to pay the mortgage. Yeah. The reality is the bank is actually using the tax rate. So all the banks using this tax rate. And I mean, the tax rate is much higher. You talk more like a 5.8% to 6.5%. So only if you can prove that you are able to servicing at that level, then you are able to get a bank funding. Yeah. So that's another thing. So this is just, you know, knowing that you are pretty safe, because the bank, they are actually the, you know, they had to be a responsible lender there. Yeah. Okay. I think I pretty much kind of covered what I need to say. And I think we got a question here and say, Kelly was asking like, how long does your business need to be established until the bank will look at borrowing to you? So if you talk about the main bank is actually 12 months minimum, 12 months minimum. There are some other like nearby lenders, yeah. So nearby lenders, they, you know, they're still assessing your income and things like that, yeah. So those, it's minimum to 6 months. Yeah. Okay. So you can actually get the, funding. Yeah. Okay. So they're actually quite flexible in terms of that. Yeah. Okay.
Yeah. Basically, I was thinking about to have a quick touch up about the tax updates, which is not quite relevant to this topic anyway. But while we're talking about the cash flow, and Lucia just talking about the lending facility, a few things I think Lucia maybe already discussed with you, that by government announcing this 10 years Allbright Liu extension and the interest deductibility, I just want to know, Lucia, does when they announce that, does bank consider reduce of the interest deductibility will also reduce the lending facility? Because you have the new tax, right?
Yeah, I think there's only one bank, which is ANZ, recently only deciding to kind of treat the rental income differently. So it depends on if your property is being purchasing like before the 27th of March, you know, they're still using their standard, which is their scale is 75%, your rental income, yeah. And then if it's the property you're purchasing after that, they actually scale at 65%. So it's actually took away a bit of borrowing power, you know, like if it's you purchasing property after the 27th of March and net rental income actually, you know, had you know, they scale 65%. Yeah. I don't know how long they're going to doing this for, because it doesn't seem the other bank is following. And I think at the bank, when you look at what ASB is doing, and ASB actually, they kind of, I mean, they have been quite aggressive in terms of the pricing. You know, they come out with these like construction loans is 1.79% floating rate for 3 years. And also they also reduce the requirement of the surplus income per month. So basically, like when we are doing the mortgage applications, we had to run this one. It's called calculator, and the calculator will actually work it out like, hey, here's your income, you know, like your earned income plus your rental incomes, and then minus your existing lendings, minus your proposed lending. and also minus your living expense, and how much left per month, And I think these things is called uncommitment UMI, which is uncommitment income, per month, So in the past, there's a requirement for the people they are borrowing over 80% lending. And I think the requirement there is need to be $900 per month, $900 per month. So they reduce this right down to $300 per month. So this means that the customer, those first home buyers, if they actually have a less than 10% deposit, they're suddenly being able to borrowing additional close to $100,000 there, So I personally feel like the ASB now, they really want to get more business, And I think ANZ does just some, they in terms of that. I think Badea one is actually quite minor. It's a $200 additional, $200, I think they reduce, like a 200, like basically the customer actually had a requirement less than $200 per month. So that $200 actually allows customer to borrow additional $34,000 more. So if you're asking me what I'm thinking is the bank, they are craving for business, because I think the lending they've been doing, obviously they started seeing the slowdown or something. So they kind of started wanted to actually asking for more business. Okay. I think that's what, in terms of what the bank, what we see at ASB and also the ANZ as well. We don't know ANZ is like, they're going to scale 65% on the rental income is going to last. I don't know, because, I did keep telling my customer and say, well, even this tax deductibility is still very, very minor, and I think even if you are running some business, I think you can actually have business borrowing money. The interest rates, the bank, mine is slightly higher. They might say, "Hi, you're still using the residential property to as a security to backing up these lendings." They might only just charging additional 0.5%. So it might be something that for some of you that you are running your business, that's something that you can look at it, because it might actually saving you some of the the tax bill there. Okay. But obviously for more detail, you need to talk to your accountant or Allbright, those charter accountants. Obviously they got experience. They will know what will be the better way to actually structure your mortgages in your business as well. Okay. So I think we got more questions comes in. So Alex is asking, how much you need to earn to borrow 800K? That's really, those are really funny questions. We can't really answer that. I think Alex, I probably will think if the best way it's probably just like for you to reaching out to us, and there's a contact form that you can actually complete. Because the problem this is like it's so broad, because obviously we need to understand like hey, whether or not you got kids, hey, whether or not you get other debts, sort of things like that. So it does have a lot of like a moving parts, and so it's just that we, it's ideally perhaps just complete a contact form to us, and then our mortgage team, very experienced people in that team. We have, myself coming from ASB 15 years, we have people from the Westpac, BNZ, ANZ, ASB, very experienced, like people from business banking, commercial banking, So those people, they can actually help you, Okay. So we got Lorenz asking, what about your general spending habits, not related to business? I.e., if you are a PAY, how can I increase my loanability from the bank? Okay. So certainly, the bank do check your bank statement and look at your spending habits. Okay. So obviously they have, usually all the bank, they have a essential living expense. So they might say, hi, if you own the house, they will say, hi, $150 per month is definitely, that's a rent rate. Insurance, probably $100 per month. So they do have their, calculator on the essential living. But obviously, if you go on top of that, you got something else, childcare. That's unfortunately, that's actually just the addition onto their essential one. So that's actually reduce your borrowing power. Yeah, okay. So Lorraine, I don't know what's your scenario. If you are looking at to assessing your borrowing ability, again, just complete a contact form. And I think one of our experienced lending staff, they can actually contact you. Okay. We got another question from Charles. So if you bought existing business, does its trading history count when it comes to borrowing from the bank's perspective? Well, it's quite a lot of lending questions here. Yeah. So I mean, yes,
they're eager to get money. Good time to buy properties.
Yeah. Okay. So if you are actually borrowing money to buy the business, and then yes, we will definitely look at your the existing business, their trading history. Absolutely, yes, yeah. Okay. Oh yeah, someone just said thank you. Yeah. Okay. Yeah. Thank you. Yeah. All right. And then we got Sue is asking the ASB loan, is it available for minor dwelling? I'm not quite sure what you are asking. Yeah. So I don't know. Yeah. But certainly, yes. I mean, you can always. I guess are you asking the construction loan you're going to be for minor dwelling, and you can get this special? Yes, certainly, yes, yeah, yes, yeah. Because basically, that's a special for construction loan. Yes, yeah, absolutely. Yeah, okay. I think we kind of we answer all of them. Yeah. And I think the for me it's probably again get a good accountant, and accountant that Allbright her sales is very, very successful. I think she has over $10 million property portfolio, so her sales is a very, very successful property investor. So if you want to engage with the accountant, because there are some accountants that really being honest, they just probably not there because they don't really coming from the property background, and then advice can be sell their properties or stuff like that, which is actually not quite right. Yeah. Or they can get quite panicking. Yeah. And they're trying to teaching you to pay less tax. The problem there is if you're paying less tax, that means that you have less income. Less income, that means that the bank is unwilling to give you money to borrow to actually buy houses. And then you ended up in a really what's a situation. Yeah. So I was encouraging my customers always paying more tax, you get more income. The bank is willing to actually allow you to lending more, giving you more money so you can actually buy houses and, build your, build your assets, and build your wealth as well. Yeah. Okay.
I totally agree with that. A lot of clients just trying to focus on how to reduce your tax payments. However, you need to understand if your dream is just to run in your little diary for the rest of the life, get $20,000 per year by saving $10,000 tax, then that's going to be end of the year. End of your life, you will have no property, no asset, and you still have to work the life off by running a little business. However, if you want to accumulate a good portfolio, don't scared to pay tax. But what I always say, it's a good way to pay tax because you use the public facilities anyway. And at the same time, when you pay the tax, to be a successful investor, you need to understand how you can use the tax you paid by talking to some professional brokers like Lucia to give you more lendings by using what you've done. Yeah, so that's very important. I'm not encouraging you to pay extra tax. We just pay what we need to, but I'm not saying you don't want to hide or take cash. Just pay what you can and use them. The most important is how actively you use them and get a good broker to support you. Yeah, that's very important.
Yeah. Okay. Yeah. So we got Sue was kind of referring to her question and saying new minor dwellings and will it be tax deductible? I think nowadays still. I don't think so for the minor dwelling because it's not separate title. Yeah, so I don't think they're going to count it as I don't think so. But I think I probably let Allbright to answer the question. Yeah. Yeah.
Okay, IRD has announcement. The government has announcement. However, they said the new build is exempt for the new rule, and as Lucia mentioned, the new build government has not given a clear definition what is the new build. Based on the announcement paper and our understanding, it's basically the properties has been receiving ACC within the 12 months after the announcement has been issued on 27th of March, which means if you're receiving ICC from 26th of March 2020 onwards, okay, and then you may be eligible to clarify the property as a new build. But as what Lucia says, a new build, if you do not, a minor house do not have separate titles. In that case, you may not receiving ICC. You may receive or may receive no title. So we are not 100% sure. Until 6th of June, government will give further announcement. Maybe we will receive further declaration what is called new build, and we will give you a better answer and clear answer. But at this stage, I would probably agree with Lucia. This probably will be a no answer.
Yeah. Okay. All right.
Yeah.
So it's a CCC. I think when Allbright was saying the CCC is a certificate of the code of compliance. Yeah. Am I right? Yeah.
They're talking about the CCC, but we're not about the title. So based on my understanding, maybe it will be focused on ICCC because by declaration for the new build, because you did do something, and maybe there was a major threshold to define what is a new build. We are not 100% sure yet until the legislation comes out.
Yeah. Okay. We got another question here. Looks like I think this is my question. So Katie is asking, so what age do the bank look at not lending you anymore? Really depends on the purpose. Yeah. So if you're buying an unoccupied and if you're in your 70s, I think it's really unlikely. Yeah. Because, unoccupied. Yeah. However, if you are in 70s and then you're buying an investment property, yes, I think the lender, they still do, you will be surprised. I think we done cases for customer in their 70s and the lender was still able to do 25 years, some do 20 years. Yeah. So because investment property, of course, the customer, they can always sell down, because it's not their unoccupied house. Yeah. So, that's quite specific. If that's actually related to you or your, family or friends, questions, again, just fill in our contact form and then just, talk to one of our staff member. We probably can help you. Yeah. Certainly we can. Yeah. Cause one of our, company's value is we never said no to our customer, always come up with a solution for you. Yeah. Okay. We got this is a private question. Yeah. So if an existing business is already acquired, which is profitable, do you still need to wait for 6 to 12 months to be able to use yes, you are quite right. Yeah. Because obviously that's, at that time there was other people that how they run their business, they are able to generate their profit. Yeah. So if you acquire them, then yes, the banker wanted to see minimum 12 months that, how you are able to run that business. Or like for the, some nearby lenders, there are quite a lot of them out there. They're very flexible in terms of that. And the minimum is 6 months. Yeah. Okay. So they can actually using the, actually they're quite flexible in terms of lending. It might be just like a GST return or like just accountants, later. Yeah. Okay. Susie is asking.
Maybe a forecast, right? Most likely.
Yes. Yeah. So Susie is asking, currently, which bank is easy to lend? It really depends on the customer's scenario. Yeah. Really depends on, like what's your position? What's your financial position? Yeah. So if you want to just again, just fill out the contact form, and then one of our experienced lending staff can actually contact you, to actually pitching out, hey, which lender, because obviously lenders, their credit policy is all slightly different, so we can actually look at your financial position and decide it and explain to you, which bank is actually easy for you. Yeah. Okay. We also have a, Luffy. Yeah. Okay. So, do you have to set up a new company if I go into property development or under an existing business?
Yeah. Okay. It purely depends on your purpose, how you're going to do the development for. A lot of people doing trading, buy and sell, and a lot of people development and for hold. And it's not a one-shoes-fit-all problem. It's a better idea to talk to a accountant or contact us, to be honest. And because but I have to say, I'm not sure why you mentioned about the existing business. I don't know what kind of business it is. If it's already a development construction company, you probably can put inside if you buy the property for sale. I mean, development for sale purpose. But generally speaking, it will give you more protections by having, if you're doing property for sale, give you more protection, limited liability by using a company to complete the process instead of using your personal name. But it is not a yes or no answer. Purely depends on what you want to do, what's in your plan, what's your cash flow, and what is your other business do. Yeah, need some one-to-one service probably. Yeah.
So just contact Allbright if you got questions. Yeah, okay. So we got another one. The private question is asking, would you prefer to investing in pocket lands around city center area or investing in bigger lands in far suburbs such as the south of Manuka? I think because we run a very successful mortgage advisory business, and we always encouraging our customer to actually investing in Central Auckland and houses, with land. Yeah. So we do have clients, like initially they might be either the bank or the mortgage broker told them that they couldn't borrow any more money. I think we got quite a lot of YouTube video, and all those customers saying like, oh, I've been to 2 mortgage brokers and I've been told that now you can't borrow any more money. And at that time, they were actually purely looking for 800K. We were able to actually come out with $1.5 million. And then on top of that, another $1.2 million. So they are, come and talk to us, because obviously we've got very experienced lenders, lending teams, and they're certainly able to actually helping you. We always want to buy, something with land, and always wanted to actually be more like in the Central Auckland, which is actually quite a safe or no risk area. Yeah. Okay. Looks like I think we already spent an hour. So that's probably everything from us, I think. Yeah. Okay. So if you are interested in, because we run those events quite often, so we do have other event actually coming up. I think the next one coming up is actually a client's actually going to share, their story with you. Now they're doing this development. Yeah. So they're going to share with you that in terms of how they actually come from buying a properties, for $1 million later on, actually that property is actually kind of like $2.5 million just in was it 12 months or 18 months time? Yeah. Okay. So there are things that we actually share with you guys as well. Yeah. Okay. And check out our one-day workshop. We got a one-day workshop coming out on the 12th of June. So in that one-day workshop, I share with you that how to actually buy your first property in Auckland. You don't need to buy units, you don't need to buy apartment, you do not need to buy new builds. And then we were, also teaching you what type of strategy that you can actually implement to actually quickly increase the value and also the rental income as well. Yeah. Okay. So I don't know, Allbright, you have anything you want to add or something? Yeah.
Yeah, I totally agree with Lucia about the last question, where you buy, and especially for buying hold. I totally agree with Lucia. Buy central, it's always safe to buy central, and that's where the profit grows, especially buying hold purpose. But it purely depends on your cash flow and what's your purpose. For a lot of my customers, they are doing trading, buy and sale. It depends on your cash flow. Well, anyway, it's still safer to do in central, but if you cannot buy, I think sometimes if you're doing trading South Auckland, it's okay. My point of view, yeah, because it's a short term in and out. But I totally agree with Lucia. It's a good idea to hold in central. It's much safer. Yeah.
Just remember, holding is always the easy. Holding is investment. Yeah, because when you are doing the tradings, lots of risk there, and also I've seen a lot of people they actually regret. So don't get into trading. I always said do not trade. Yeah, just remember this, because I already seen. Obviously, I spent 15 years in the bank, and then 5 years in the business. In the same thing. Basically in these properties and the bankings, finance things. Yeah, I've seen people actually after 30 years in property, and then they can end up nothing. Yeah. So just be very careful that, always be an investor. Do not be a trader. Yeah. Okay. All right. So I think that's actually us for tonight. And thank you for you guys joining us today. And I hope to being able to seeing you, in our other events. And of course, if you got any questions, for Allbright, you feel welcome to actually. Have we got your contact detail, Allbright?
I think it's on the last slide, is it?
Yeah, if it's you want Allbright's contact detail, you can always just contact us. We're happy to share with you. Yeah, okay, yeah, all right. Oh, sorry, I think we got something. Is it recommended to have new company for every new development? Will it be too risky if just using the same company? Thanks. Oh, that's for Allbright for you, yeah.
Yeah, well, again, it depends on what you want to do for the new development. Are you going to buy and sell, buy and trade, or buy and hold? It purely depends. And it also depends, are you doing that by yourself or are you doing that with your partners? It is a correct way to use a company to protect your limited liabilities when you do development. However, either you're going to use every property with a new company, not 100% sure, depends on what you want to do. Yeah.
So again, just reach out to Allbright, yeah, and then listen to her advice, yeah. I think and so thank you for everybody. Craig Mason, yeah, Craig Mason's overseeing. Oh, I think you are back now, right? Yeah, okay, cool, yeah. So I'm gonna see you on the weekend, yeah, our master class. So on this weekend we're running a master class for our members, yeah. Okay, and I think so. Thank you everybody, and enjoy your evening, yeah. Good night.
Thank you very much. Thank you, everybody. Good night.